Financial Ratio Analysis, Part 1, Lecture 8. Lecture Outline. Hello, welcome to Lecture 8 of Value Investing. This lecture is on financial ratios. It is the first of a two-part lecture on this topic, and we're going to talk about a variety of different financial ratios in this lecture and the next. And this lecture will mainly talk about ratios, and the next lectures will also look at an example. So what we want to look at are the different types of financial ratios and go into a little bit of detail for each type. So the first one we'll talk about is profitability ratios. Then we'll talk about return ratios. Then we'll talk about debt ratios. Then we'll talk about liquidity ratios. Then asset utilization ratios. Then cash flow ratios, and finally valuation ratios. Now, a lot of these ratios are going to come from the company accounts and other variables as well. And we have spent the previous two lectures talking about accounting. So it's important that you are up to speed with those two lectures and understand basic accounting because you would need that in order to learn about these ratios. Okay, let's get started. Financial ratios. So the first thing we want to talk about is what is a financial ratio? Financial ratios examine the relative magnitude of two or more variables related to a company. So first think about what exactly a ratio is. A ratio is just the relationship between two particular numbers. So for example, 1/2 means a half, which is the ratio of 1 to 2. So a ratio is just a mathematical term looking at one number relative to another. And when we talk about financial ratios, we're looking at variables that are related to the company that we're analyzing. And typically these ratios allow us to understand the company better. So ratios come from two different sources. We have accounting-based variables and we have market-based variables. So accounting-based variables are items that come from the company's accounts. So for example, earnings would be an accounting-based variable. And as I mentioned earlier, in order to understand these accounting-based variables, it's important that you're comfortable with what we did in the last two lectures. So these are accounting-based variables, and then we have market-based variables, which are items that come from the market. So for example, the stock price. Okay, so these two variables, we draw on accounting-based and market-based variables in order to come up with financial ratios. So why do we use financial ratios? Well, financial ratios allow us to draw conclusions about a company's stock that we are interested in analyzing. Because often what happens is when you look at a set of accounts, there are a lot of numbers in there, and because there are so many numbers there, it may be difficult to make sense of what's going on. So financial ratios allow us to consolidate the information into nice little summary statistics. So we can think of financial ratios as summary statistics that paint a picture of a particular company. Therefore, the purpose of financial ratios is to understand more about the company that we are analyzing, right? How well is this company actually performing? And a lot of these financial ratios will help us to do that. So financial ratios also have their limitations, as we'll see when we talk about the different ones. Many of them will tell us something interesting about the company, but there are also limitations that we need to keep in mind whenever we actually use financial ratios. Okay, so now we've talked about what financial ratios are. Let's now go ahead and start talking about the different types of ratios. Profitability ratios, operating profit margin. So the first type of ratio we'll talk about are profitability ratios. So profitability ratios measure how profitable a company is. So operating profit margin is the ratio of operating profit to total revenue. So total revenue is just total sales of the company, and we discussed this in the accounting lectures. Operating profit, which we also saw in the previous lectures, that's the profit before depreciation, interest, and tax. So what we would do in order to calculate operating profit margin, we would take revenues and we would subtract all the expenses related to the company's operations. So we would subtract the cost of raw materials, the cost of manufacturing, salaries, marketing, logistics, essentially all the things that the company needs in order to run its operations. So the only things we exclude are depreciation, interest, and tax. So operating profit is the most important profitability ratio, and this is because it gives a clear picture about the health of the company's core business. So the reason we don't like to include things like depreciation, interest, and tax is because that's typically outside the company's control, and operating profit looks directly at, what the cost of making their items are. So in some sense, it reflects the management's efficiency. And as we said, it does not include expenses such as interest and taxes, which depend on external factors. So the operating profit margin, therefore, is an important ratio, and typically, as you can imagine, the higher the operating profit margin, the better, right? So we're looking at operating profit divided by revenue. So the more profit we have relative to revenue, that's a signal that the company is doing better. Profitability ratios, net profit margin. So the next type of ratio we'll look at is also a profitability ratio, and this is net profit margin. So net profit margin is the ratio of net profit to total revenue, and it's very similar conceptually to operating profit margin. We're taking the profits and dividing it by total revenue. The difference is that with operating profit, we use with the operating profit margin, we used operating profit, and in this case, we're going to use net profit. So what is the difference between net profit and operating profit? Well, net profit takes into account all of a company's costs. So previously said that with operating profit, we exclude items like interest, depreciation, and taxes. When we look at the net profit margin, we want to include all of these items. So we actually want to look at the net profit of the company, taking into account all of their costs, and then taking the net profit divided by total revenue. So net profit margin is equal to profit after tax divided by revenue. It measures the percentage of sales that the company keeps in profits. And also for net profit margin, like operating profit margin, the higher the number is, the better. So let's say a few words about, why would both of these ratios be interesting, and what are the advantages and disadvantages of each. So operating profit, the advantage of using that is that it only looks at the company's core business, so it ignores costs that are largely outside the company's control. So from that perspective, it is a good indicator of how the company is operating and how efficient they are. The disadvantage, of course, is that it doesn't tell you the company's other costs. So for example, if a company has high debt levels, you might have high interest costs, and that would not be reflected in operating profit. So net profit takes into account all of these things, so for that reason it's good. The downside of net profit, of course, is that it takes into account a lot of things the company may not be able to control, so it may not be as good a signal of how good the company is at generating sales and how good they are at generating profits. Profitability ratios, effective tax rate. So the next profitability ratio we'll talk about is the effective tax rate. The effective tax rate is the average rate at which a company's profits are taxed. So the way we calculate effective tax rate is we take tax expenses and we divide it by profit before tax. So why is this ratio important? Well, marginal rates vary for companies, and there are many deductions, tax incentives that can determine how much a company pays in tax. So as you know, every company has to hire many accountants, usually large companies, in order to do the accounts and work out how much tax they pay. And typically that's because, different things are taxed at different rates. There are various exemptions, deductions, depending on the activity the company is doing. So there are a whole host of different tax laws that may apply to a company. So it's not necessarily straightforward to say that the company pays, X amount of tax on its profits. So instead what we do is we just look at the effective tax rate. So we look at the total amount of tax the company paid and divide it by their profit before tax. And this is a nice summary statistic to tell us what the company's tax rate actually is. Because internally within that there may be so many different tax rates and taxes going on, this is a nice way to summarize it. So as we said, the effective tax rate is an easy way to summarize how much tax a company pays. And one reason it's good is that because the effective tax rate tends to be relatively stable over time. So if the company was able to claim certain deductions this year, they'll probably be able to do the same next year. So the effective tax rate is a reasonable indicator of how much tax the company will pay in the future. The only time it may not be as useful as if there is a significant change in tax laws. So if you're analyzing a company's earnings for the following year, trying to forecast them, and there are significant changes in tax laws, then this effective tax rate may not be what we necessarily expect it to be. But in general, the effective tax rate is fairly stable over time for companies. Profitability ratios, banks, net interest margin. So the next type of profitability ratio we'll talk about is the net interest margin, and this one applies particularly to banks. So what is net interest margin? Net interest margin examines how much a firm makes from its investments relative to how much it pays on its debt. So if you think about a firm that earns interest from various investments and also pays interest from its debt, the difference between the two is the net interest margin. So let's take an example in the context of a bank, because this is really mostly applicable to banks anyway. So what does a bank do? Well, a bank takes deposits from its customers and pays interest to customers on those deposits, right? And at the same time, they also lend money to individuals looking to borrow, and those individuals pay the bank interest on those loans. So a bank will charge different interest rates for these two things. So they might charge their borrowers a higher interest rate than what they pay to their depositors, and the difference becomes the net interest margin. So we take how much they earn from making loans to borrowers and compare that to what they have to pay when taking deposits from savers, and also what they pay to their creditors. So how exactly do we calculate net interest margin? Well, we take interest income, and then we subtract interest expenses, and then divide that by average earning assets. So it's a pretty simple way to look at how much does a company make from their investments in interest versus how much do they pay in interest. And obviously we would want this ratio to be positive. We would want interest income to be higher than interest expenses. If that were not the case, then the bank could be in a danger of going bust or something. But in general, it will be higher, and the higher it is, the more it represents that the company is more effective and has a higher net interest margin. And then we divide by average earning assets in order to scale back that allow us to easily compare companies with different level of assets. So we're really looking at interest relative to the earning assets of the company. Profitability ratios, banks, net NPA to loans. So the next type of profitability ratio we'll talk about is net NPA to loans, and this again is also applicable primarily to banks. So NPA stands for non-performing assets, and this typically means loans that may be in default. So when a bank makes a loan to a customer, that becomes an asset for the bank, right? Because they expect that money to be paid back over time. And if the customer is possibly defaulting on the loan, then this would refer to a non-performing asset. So from the perspective of the bank, these assets are ones that they don't expect will be converted to cash, or equivalently, they do not expect that these loans will be paid, right? So they're expecting that the customer is likely to default on the loans. So how exactly do we calculate the ratio? So we take the net NPA, so we want the net value of non-performing assets, and then we divide that by the total value of loans. So for example, let's say I have loans worth $1 million, and let's say 10,000 of those loans are non-performing. Then I would take 10,000 divided by $1 million. That would give me 1%. So that would mean that 1% of the bank's loans are likely to be in default. All right. So we're looking at what percentage of the bank's total loans is likely to end up in default, and that's what this ratio is telling us. So what does this mean for the bank when we're analyzing the bank's financial statements? Well, if this ratio is high, a high ratio indicates that there are a lot of non-performing assets or a lot of defaults ready to occur. It means that the bank may have to write off bad loans, and this will reduce its future profitability. Right? So banks that maybe take too much risk when they're lending or lend to too many risky customers may face high NPA to loans ratio, and this would indicate that in the future they may have to reduce, they may have to write off these loans, and this will cause a reduction in profits in the future. So this is an important statistic that tells us, how many of the bank's loans are actually going to be paid off and how many will not. Return ratios, return on equity. So now we've talked about profitability ratios, we'll now move on to return ratios. The first ratio we'll talk about is the return on equity. The return on equity measures the net profit generated by the company relative to the shareholders' funds. So we looked at equity in the accounting lecture, and we saw that equity is the total amount invested by shareholders, and return on equity measures how much profit is generated relative to the shareholders' funds. So the way we calculate it is that we take net profit and we divide it by shareholders' funds. And it is another measure of profitability, and it measures how productively a company uses its equity capital. So if a company has a certain amount of equity capital, we want to know how well do they use it, how much profit are they able to generate from it, then the return on equity gives us that number. So there's one key limitation of return on equity, and that is that the ratio does not take into account debt capital. So companies can be financed with either equity or debt. And if a company takes a lot of debt capital, it will have less equity capital, and vice versa. So if they have a high level of debt and correspondingly a low level of equity, then this return on equity ratio will look very high, right? Because the total equity is quite low. So if we were to take a company with high levels of debt, we might see a very high ROE or a high return on equity. But this may not be indicative that the company is actually producing very high returns. So we must consider other ratios as well, and return on equity on its own is not sufficient to tell us, that the company is doing well or they're not. But still, it is a very useful statistic. It's heavily cited and heavily used. So from that perspective, it's good. It represents, how much return equity holders expect, and for this reason, it's a very, very useful statistic. Return ratios, return on capital employed. The next return ratio we'll talk about is the return on capital employed. So first, what is capital employed? Well, capital employed is looking at how much capital does the company use. So when we say employed, we mean how much do they use. And the return on capital employed looks at how much profit is the company making relative to the capital it uses. So we can think of it as, how efficiently do they use their capital? How much return do they make based on the amount of capital that they have? So the way we calculate return on capital employed is that we take net operating profit after tax, or abbreviated as NOPAT, N-O-P-A-T, and we divide that by capital employed. So what exactly is NOPAT, or net operating profit after tax? So the way we calculate it is that we would take profit before interest and tax, and then we times it by 1 minus the tax rate. So the key thing here is that we do not include our interest expense. So we're looking at profit before interest and tax, and then correcting for tax. So essentially, we take profits excluding interest. So we just want the operating profit, and then we look at what would be that after taking into account taxes. Capital employed is equal to shareholders' funds plus total debt. So capital employed is how much capital the company has at its disposal, and this is going to be equal to the total amount of shareholders' funds or shareholders' equity plus the total debt. So shareholders' funds we saw in the previous slide, and now we're also going to take into account total debt. And the reason this ratio is good in that sense is that we do take into account the total debt as well. So if the company has a high level of debt, it will reflect in the capital employed figure. And what ROCE does is that it provides a more complete assessment of how well a management is deploying its capital. So a management has a various amount of capital to use in order to generate returns, and ROCE is a good way for us to know how well are they using their capital. So that's the reason we use ROCE. And unlike return on equity, if a company has high debt levels, then that will be reflected in this ratio. It won't result in a rise. So for that reason, it's good. Compared to ROE, ROE is a little bit better for understanding how much shareholders would get, because it is the return directly on shareholders' funds, whereas this one looks at return for both shareholders and creditors as well, because we're also taking into account the total debt of the company. Okay, so that's the return on capital employed. Return ratios, return on assets. So the last return ratio we'll look at is the return on assets. And return on assets measures how much profit a company generates relative to its total assets. So total assets is an item on the balance sheet, which we saw in the previous lecture. And the way we calculate return on assets is that we take the net profit of the company and we just divide it by the total assets. So the calculation is very similar to return on equity. Okay, the only difference is that we're going to use total assets in the denominator instead of shareholders' equity. And when we look at total assets, we are including all the assets of the company. So this includes productive assets as well as non-productive ones. So if we compare this with return on capital employed is looking at how much the capital that the company actually uses in order to create profits. In the case of return on assets, we're looking at all the company's available assets. This includes productive ones as well as non-productive ones. So what is something that could affect the ROA? Well, suppose, for example, a company has a very large cash balance that it isn't using towards anything. So that cash balance is not being invested, or it's not being used in order to generate profits. They're simply holding the cash. Well, then this would bring down return on assets, right? Because we know that cash is an asset, and if the asset is not doing anything, essentially we're just adding to the total assets, and it's not necessarily impacting the net profit. So if we have high cash balance, this would bring down the return on assets. And return on assets obviously includes, all of the company's assets. So it's more complete as opposed to just looking at return on equity, right? So for this reason, return on assets is a good statistic for us to look at. Debt ratios, debt to equity. So now we've looked at return ratios, and we earlier looked at profitability ratios. We're now going to go on to talk about debt ratios. So debt is something that's very important, right? We understand that companies do borrow money in order to fund their operations and invest. And debt ratios tell us about the company's debt. Is the debt very high? Is it very low? And other things about the debt as well. So the first statistic we'll look at is the debt to equity ratio. The debt to equity ratio measures how much leverage a company has. So equivalently, the debt to equity ratio is measuring what proportion of the company's assets are financed with equity or debt. So as we know, the total assets of a company can be divided into debt or equity, right? So equity is shareholders' funds, and debt is what the company owes to creditors, or money that they've borrowed. So when we look at the debt to equity ratio, we're looking at how much debt does a company have relative to its equity. So how do we calculate the debt to equity ratio? So we would take the total debt of the company, right? So everything that the company owes, so this is the company's total debt, and we would divide this by the shareholders' equity, right? So we're simply looking at how much debt does the company have versus how much equity does the company have. So obviously, the higher this ratio is, this tells us that the company has more debt, right? And what does it mean when a company has more debt? Well, it means that the company is more risky, right? Because we know that debt is more risky than equity, because with debt, companies have to pay the interest on that debt in every year, regardless of how they perform. So if they have a bad year, they may struggle to meet their interest obligations. Whereas with equity, equity tends to pay off when the company does well, but they don't have to pay off as much when the company doesn't do so well. So higher levels of debt is more risky, as we said, because it can increase interest liabilities. There are some advantages to using debt as well. One is that debt can be a little cheaper in terms of how much it costs the company to finance the debt, for two reasons. The first is that often interest expenses are tax deductible, right? Taxes are paid after we deduct interest. In addition, debt investors tend to get lower returns than equity investors, so the company has to pay out less to their debt holders as compared to their equity holders. Debt ratios, interest coverage. So the next debt ratio we'll look at is called the interest coverage ratio. What is the interest coverage ratio? Well, the interest coverage ratio measures how easy is it for a company to meet its debt obligations. So when a company takes out debt, it has to pay interest on that debt, right? And interest is paid at regular intervals. So this ratio allows us to get an idea of how much interest is the company paying, and is it easy or difficult for the company to pay this interest, i.e. to meet its debt obligations. So the way we calculate interest coverage is that we take the earnings before interest and taxes, and then we divide it by the interest expense. Alright, so we're looking at how much has the company earned before taking into account the interest and taxes that it has to pay, divided by how much interest does it pay. So how would we interpret this ratio if we saw it? Well, if this ratio is close to 1, okay, or below 1, then that's a real problem, right? That's saying that the amount the company is earning is less than how much they have to pay in interest, right? So let's imagine this ratio was less than 1. Then the company would not be earning enough to actually meet its interest obligations. And even if this ratio is slightly above 1, it would still mean that most of the company's earnings are simply going off to pay its debt. So in general, if we see this ratio near 1, that indicates that the company is having problems meeting its debt obligations. There's also a link between the debt to equity ratio and the interest coverage ratio. So the debt to equity ratio measures how much debt a company has. And as you can imagine, the more debt the company has, the greater its interest expense will be, right? So if you have a high debt to equity ratio, you'll have a higher interest expense, which will lead to a lower interest coverage ratio. The other thing interest expense or interest coverage also depends on, that's not necessarily captured in the debt to equity ratio, is the interest rate the company faces. So the higher the interest rate the company has to face, the greater their interest expense will be, right? Because they have to pay higher interest on the loans they've taken out. Debt ratios, free cash flow to debt. So the last debt ratio we'll look at is the free cash flow to debt ratio. So first let's discuss what exactly is free cash flow. Free cash flow is the cash a company generates after paying for its capital expenditures. So essentially we look at how much cash does the company generate from its operating activities, right? So this is from its revenues minus its costs, operating costs. And then we also subtract away how much the company spends on investments, right, on capital expenditures, and what's left over becomes the free cash flow. So a nice way to summarize that is that we take the operating cash flow and we subtract capital expenditures. The one reason we like to use cash flow is that it is more difficult to manipulate than earnings. So we looked at that in the previous lectures, where with earnings you could do things with depreciation, you can write off certain assets in the way you want them to. It's a little bit more easy to manipulate earnings, whereas cash flow is much less easy to manipulate. So this is one reason we like to look at cash flow as well. So the free cash flow to debt ratio is a simple calculation. We take the total free cash flow of the company and divide it by the total debt. And as we said, free cash flow is equal to the cash flow from operations minus CapEx, which is short for capital expenditures. And what is this ratio actually measuring? Well, this ratio measures the ability of a company to finance its debt obligations from its cash flow. So previously we looked at interest coverage, and that was looking at the company's earnings relative to its interest expense, or how much it had to pay. So this is kind of looking at something similar, although the calculation is different. We're looking at how much cash does the company have, right? And how easy is it for them to meet their debt obligations given how much free cash flow they generate, right? So that's what this ratio is looking at. And this is very useful because, as we said, cash flow is more difficult to manipulate as compared with earnings. Liquidity ratios. So the next category of ratios we'll talk about are liquidity ratios. And we actually only have one liquidity ratio that we'll talk about. And we're going to talk about what is called a current ratio. So the current ratio measures the ability of a company to meet its short-term obligations. So let's think first about what it means to have a liquidity ratio. So liquidity is about how much cash the company has, right? Is the company have enough cash to meet its obligations? And a company that's facing illiquidity may mean that it does not have the cash flow to actually meet its operations. So the current ratio is a way that which we can measure how easy is it for a company to meet its short-term obligations. The way we calculate the current ratio is that we take current assets and divide it by current liabilities. So let's think back to what current assets and current liabilities are. So current assets are essentially short-term assets, and these are assets that would likely be converted to cash within the year. Either they're cash itself or they could be converted to cash within a year. And current liabilities is the same. These are liabilities that will come due for the company within a year typically. Right, so this is a short-term ratio, and we're looking at how much cash does the company have or expect to receive during the year versus how much do they have to pay out. Okay, and obviously we want this ratio to be high. If this ratio is close to 1 or at 1, then that's a problem. So suppose this ratio is less than 1. That would mean that the current assets would be less than the current liabilities. And this is a big problem because this would indicate that the company would be unable to meet its current obligations if they came due. So if they had to pay off all their current obligations now with their current assets, they would not be able to do so. And as we said, short-term refers to any obligations that are due in the next 12 months. So one key point to keep in mind is that liquidity is not the same thing as bankruptcy. So just because a company may be illiquid, if it doesn't have enough assets to meet its short-term liabilities, doesn't mean that it's bankrupt or it's a company that's going to shut down. It's more of a short-term ratio looking at their immediate cash flow versus their immediate cash needs.
Asset utilization ratios, fixed asset turnover. So the next set of ratios we'll talk about are called asset utilization ratios. Now from the name you can probably infer that what this means is that we're looking at how does a company use its assets, and in some cases how well do they use their assets. So the first ratio we'll talk about is called a fixed asset turnover. The fixed asset turnover measures the company's ability to generate sales relative to its fixed assets. So we're kind of looking at how much does the company sell, so what are the company's revenues in relation to their fixed assets. So what exactly is a fixed asset? Well, a fixed asset essentially includes assets such as property, plant, and equipment. So this is applicable particularly for manufacturing firms that have large factories and they have lots of equipment, and these become their fixed assets. So how do we calculate the fixed asset turnover? Well, it's a fairly straightforward calculation. We're looking at the ratio of a company's total sales to its fixed assets. So the fixed asset turnover is equal to net sales divided by fixed assets. So in some sense, you can think of this as being, how much does the company sell given its level of fixed assets, right? So how efficiently are they using their fixed assets in order to make sales? Now, obviously, in this situation, you would want a higher number, right? Because the more sales you have, the better. And the more sales you have relative to your fixed assets, the better. So when we have a higher number, this indicates that the company is more effective in using its assets to generate sales. So this is a common ratio used for manufacturing companies, as we said, and the reason for that is that manufacturing companies tend to have a lot of fixed assets such as property, plant, and equipment, and those fixed assets are often, directly responsible for the company to manufacture its goods, right? Without those machines and factories, the company would not be able to manufacture anything. So that's why this ratio we use primarily whenever we are analyzing manufacturing companies. Asset utilization ratios, inventory days. So the next asset utilization ratio we'll look at is one called inventory days. So first let's talk about inventory days and what that means. Firstly, inventory. Inventory is the stock of goods that a company holds. So for example, if a company is producing a particular good and then they're selling that good, the time between when the good has already been produced and when they sell it, right? That means that the good is part of the inventory, right? That's like, if you can think about it like what is currently on the shop floor for a company, right? They've already produced the good but not yet sold it. So when we're looking at inventory days, we're looking at the average number of days that a company's goods remain in inventory. Okay? So how long before, once the company produces the good, before they actually end up selling it. So the way we measure inventory days is we take the inventory, okay, divided by the cost of sales times 365 days. So let's break this down a little bit. So we understand what inventory means, right? How much inventory does the company hold? And cost of sales is essentially what is the cost used to make those goods. Okay, and this is the reason we use cost of sales rather than revenue is that when we're looking at inventory, the company has expended a certain cost to make that good, and we want to know how much of that good they're holding relative to what it cost to make that good. And then we multiply it by 365 days, and this kind of gives us a number that tells us, how many days does the company hold its inventory, and usually it means how many days within a year. So in general, a lower figure is better, right? As it implies that the company can shift its stock more quickly. So the longer items remain in inventory, the greater the cost for the company because they have to store it longer, and it takes longer for them to receive their revenue. So in general, we would want a lower figure for inventory days. Now usually we would use average inventory over the relevant time period. So if I'm looking at cost of sales between, let's say, over a 3-month period, I would take the average inventory over those 3 months and calculate inventory days using that. Asset utilization ratios, receivables days, and payables days. So the final set of asset utilization ratios we'll talk about are receivables days and payables days. Now if you remember, receivables was an item on the balance sheet, as was payables, so we're going to do something a little similar to what we did with inventory, where we'll convert this into an annualized figure as the number of days and then understand it from there. So receivables days measures how long it takes for a company to collect revenue after a sale has been made. So as we know, sometimes when we make a sale, we don't receive the cash right away, right? We may receive it at a later date. And in this, when we look at receivables, we're measuring, how long does it actually take to receive that cash, right? So if a company makes a sale, then it has to wait for the cash to come. And if it takes a very long time to receive that cash, then that's obviously not a good thing, right? So the lower receivables days are generally better. Receivables days is calculated as the accounts receivable divided by revenue, right? So we're looking at the company's total revenue and how much of that is actually still in receivables, and then we multiply it by 365 days to get an annualized figure. So the next thing we'll look at is payables days, and payables days is a very similar concept to receivables days, and in this case we're looking for how long does the company take to pay its creditors for its inputs purchased. So in this case, the company is the customer and it's buying inputs from someone else, from its creditors, and it has to pay its creditors, and we're looking at how long does it take for them to pay the creditors, or how many days. And the formula for payables days is equal to accounts payable divided by cost of sales, right? And we use cost of sales because that's what the company is actually paying for the items. Then we multiply it all by 365 to get an annualized figure. Cash flow ratios, operating cash flow to sales. The next set of ratios we will look at are cash flow ratios, and cash flow ratios are essentially derived from the cash flow statement primarily, and looking at, in this case we're looking at operating cash flow to sales. So we're looking at what is the company's cash that they're receiving from their operations relative to their actual sales. So what operating cash flow to sales measures is that it measures how well a company is able to turn its sales into cash, right? And this is important because we do distinguish between the fact that when the sale is made, that is not necessarily when the cash is also received. So if we were to calculate operating cash flow to sales, we would simply take the operating cash flow in a particular period and divide it by the revenue over that period. Now, what we should be looking for here is that if we see a rise in the company's sales, we should also see a corresponding rise in the operating cash flow. Right? So these two numbers should be pretty close together generally, and if one goes up, the other should go up, and vice versa. So really the issue comes up when we see that this is not happening, right? Where, for example, we see that a company's sales might be going up, but it's not backed up by an increase in operating cash flow. So if this is happening, then we need to understand why the sales are not being converted into cash, right? So if a company is recording more revenue, but they're not receiving actual cash for that revenue, why is that the case? And if this is something that is persisting for some time, we might question how sustainable their sales might be. It might be that they don't expect to receive all the cash that they made the sales from. It may also be that they were very aggressive in their accounting for their sales, and that's why it wasn't backed up with an increase in cash flow as well. And both of these things are red flags, right? So aggressive accounting is a red flag, and also unsustainability of sales is also a red flag. So that's why this ratio is quite important, and that's why we can understand more about their cash flow and their sales from it. Cash flow ratios, free cash flow to operating cash flow. The next ratio we'll look at is the free cash flow to the operating cash flow. And this is two items that are on the cash flow statement themselves. So first let's talk about free cash flow. What is free cash flow? Well, free cash flow is equivalent to what is left over from operating cash flow after capital expenditures. So once a company receives its operating cash flow, let's say from its sales minus its cost of sales, then it also has to make capital expenditures, right? It has to perhaps reinvest in property or plants, or invest in maintenance of these things, for example. And once capital expenditures are made, what's left over is called free cash flow. The way we calculate this ratio is as follows. So we take free cash flow and divide it by operating cash flow, and we can write this as the operating cash flow minus capital expenditures. So that itself is the free cash flow, and then all of that divided by the operating cash flow. In general, the higher the ratio, the greater the financial strength of the company, right? Because the higher this ratio is, that means the operating cash flow is very high relative to capital expenditures, right? And that means that they are a strong company. One thing we would want to keep in mind is that if a business is a new business, all right, then they're likely to have a lot of capital expenditure, which would push this ratio lower. And having a high capital expenditure means that the free cash flow is quite low relative to the operating cash flow. So if it's a new business that's expanding, then this may not be such a big problem, right? We would expect this to occur. But if it is the case that it's an established business that are not planning any major expansions, but still have very high capital expenditures, then this could be a problem, right? Because that means their free cash flow, which is actually the cash that they have left over in the end, is much lower than what their operating cash flow is. So therefore, we can use the free cash flow to operating cash flow to measure the financial strength of a company. Cash flow ratios, dividend payout. So the final cash flow ratio we will look at is called the dividend payout. So this looks at how much does the company pay in dividends. So first of all, what is a dividend? A dividend is essentially, once the company has made profits, let's say for the whole financial year or every 6 months, however often they pay dividends, once they make their profits, they decide how much of those profits to keep within the company and how much of that to pay off to shareholders as dividends. Right, so if you own shares in a company, then you should receive dividends, which is kind of like the residual profits paid out to shareholders. So companies divide their profits into retained earnings and dividends, and the dividend payout ratio is measuring the proportion of the company's earnings that are paid out as dividends. The way we would measure the dividend payout is that we would take the total dividend divided by the net profit. Right, so how much of the net profit, that is what they've made after all their costs and taxes, or accounted for, how much of that is paid out as dividends versus how much of that goes into retained earnings. Now, what tends to happen in practice is that most companies like to maintain a steady dividend payout ratio, right? So they like to, for example, say fix the dividend payout ratio, and then whatever the net profit is, just pay that particular fraction as a dividend. And one reason for this is that, a fall in the dividend payout ratio, or just a fall in dividends, is usually seen as a bad sign for a company. Falls in the ratio tend to hurt the stock price because investors also tend to see higher dividend paying stocks. So one reason that the dividend is such a strong signal is that because when a company lowers its dividend, it's usually an indication that the company is in a bit of trouble, right? That their profits are much lower than they expected, or they expect future profits to be much lower, which is why they want to hold more cash. So a fall in dividend is usually seen as a poor sign, and that's why it tends to hurt the stock price. And that's also why companies have a pretty strong incentive to try and maintain a steady dividend payout ratio. So you'll find that most companies try and do this as much as they can. Valuation ratios, price to earnings. So now we've come to the last category of financial ratios that we're going to look at, and we'll be looking at valuation ratios. And these are particularly important, especially for when we're trying to find out what we think the valuation for the company is. So the first one we'll look at is the price to earnings ratio. The price to earnings ratio measures the price of a company's stock relative to the earnings per share. Right? So for each given share, each share has a price, right? And then each share also has an earnings. So we have an earnings per share, and then we have the price per share, and the PE ratio is just the price divided by the earnings. So we calculate this as the market price per share divided by the earnings per share. So how can we understand this this ratio on an intuitive level? Well, from the perspective of an investor, we're measuring how much we are paying for a given level of earnings, right? So how much do we have to pay to get 1 unit of earnings? Higher PE ratios indicate that we are paying more for a given level of earnings, and vice versa. So lower PE ratios would mean that we are paying less for a given level of earnings. So one caveat when using the PE ratio is that a higher PE stock does not necessarily expensive stock, and vice versa. So obviously when the PE ratio is higher, it means that we are paying more money for a given level of earnings. And this is, this is not necessarily a sign that the stock is overvalued, simply because future growth has to be taken into account. So the PE ratio might be high, but if the company is expected to have strong growth in the future, then that would justify the high PE ratio. And in general, the way we tend to use the PE ratio is to compare multiples of companies within the same industry. So what we'll find in practice is that PE ratios tend to vary a lot across different industries, and they're not a good tool to compare companies in different industries. They're primarily useful for comparing companies within the same industry, since within the same industry we would expect companies to have similar PE ratios. Valuation ratios, price to book value. So the next valuation ratio we'll look at is the price to book value ratio. So the price to book value measures the market price per share relative to the book value per share. So we saw that in the previous ratio we were looking at the market price per share to earnings per share, and now we're just going to change earnings with the book value per share. So what is the book value? Well, the book value is equal to the company's net worth or shareholders' funds. So if we look at a balance statement and we want the book value, we would simply take the assets minus all the liabilities, and whatever is left over, the total equity, that's the book value of the company. And one way to interpret the book value of the company is that what would happen if this company were to go bankrupt today, all right, and what would be left over. So if the company were to go bankrupt today, let's say we have assets and liabilities and we have equity. If a company went bankrupt today, it would have to turn all its assets into cash. Then it would have to use those assets to pay off all its liabilities, and then whatever would be left over, that would be the book value of the company, or equivalently the shareholders' equity. So the way we calculate this is that we take the market price per share and divide it by the book value per share. A higher price to book ratio means we are paying more for the stock relative to its book value. And what we tend to find in general is that, the market value per share is almost always higher than the book value per share. And that's because the book value per share is kind of like the minimum value you would expect, because that can be realized if the company were to go bankrupt. Whereas if we're expecting earnings growth in the future, then the market price per share should be higher than the book value per share. So in general, a higher PB means we're paying more for the stock relative to its book value. And like when we talked about the price earnings ratio, a high price to book ratio does not mean that the company is overvalued. It simply means that it could mean that higher future earnings growth is expected, or it could also mean that it's overvalued. It could be either one. And also we would tend to compare price to book ratios for companies within the same industry rather than across industries. Valuation ratios, EV to EBITDA. So the next valuation ratio we'll talk about is EV, which is the enterprise value, to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So what is enterprise value, or EV? So enterprise value is the sum of the market capitalization, debt, minority interest, and preferred shares minus the company's cash. And what this measures is the takeover value of a company, right? So the enterprise value would be, well, what would you have to pay if you wanted to take over the company? And EBITDA is, as we said, earnings before interest, taxes, depreciation, and amortization. And the EV to EBITDA ratio is used to determine the company's value in a similar way to the PE ratio. So let's break this down a little bit. EV is looking at the market value of the company, right? So it's the takeover value of the company, right? So how much you would pay to take over the company. But you can think about it as the company's value, right? And then the EBITDA is like the company's gross sales, okay, before we take various costs into account. It's their sales, then less their cost of sales. But before we take into account interest, taxes, depreciation, and amortization. So the EV to EBITDA ratio is a ratio of the company's value relative to its earnings, right? So the higher this is, that means the more expensive the company is. And in that sense, it has a similar interpretation as the PE ratio. PE, we have the market price divided by the earnings, and here we have the takeover value divided by the earnings before taxes, interest, taxes, depreciation, and amortization. And again, the same caveats would apply as with the PE ratio and others, that we would tend to use it to compare companies within the same industry rather than comparing companies across different industries, because we do expect that this value would fluctuate significantly otherwise. Valuation ratios, price to sales. The price to sales ratio measures the price per share relative to the sales per share of a company. So this is again quite similar to price to earnings ratio, and instead of using earnings per share, we'll use sales per share. So we would calculate this as the market price per share divided by the sales per share. And the price to sales ratio will measure how much are we paying for a given level of sales. And mainly the price to sales ratio is used as an alternative to the PE ratio. It's not necessarily as informative in terms of how much as a shareholder you're earning, because as a shareholder you care more about the net profit rather than the sales. But still, it's it may be a good indicator, because the sales and profits do tend to move in the same direction, right? So if a company's sales go up, its profits are going up too, and vice versa. And the reason we'd like to use price to sales ratio is that sales tend to be more difficult to manipulate as compared with earnings. So what tends to happen with earnings is that we have all these various other things, like for example depreciation, which can depend on how you do your accounts. So typically it's easier to manipulate earnings as compared to sales, right? Where sales is just going to be how much you sell. So that's the main benefit of using this price to sales ratio over the price to earnings ratio. The main drawback, of course, is that sales doesn't provide as much information as earnings, right? Because earnings takes into account sales plus and minuses all the costs away, whereas the sales itself does not do that. So we face a little trade-off that we probably get a number that's more difficult to manipulate, but we get a number that's less informative. Valuation ratios, dividend yield. The next valuation ratio we'll look at is called the dividend yield. The dividend yield measures the dividend per share relative to the market price per share. So again, what we're doing here is something similar to the PE ratio, but instead of using earnings, we're going to use dividends. And it's also inverted, so dividends is on the numerator and the market price per share on the denominator. So we calculate the dividend yield as the dividend per share divided by the market price per share. So essentially this number would come out as a percentage, and we would think, well, this is the dividend return I'm getting for every time I invest in one stock. So it measures the dividend return from holding the stock, right? So if the dividend yield was 5%, that would mean that when you hold the stock, you earn a 5% dividend return. So one thing I'd like to point out is that we need to look at the difference between this ratio, the dividend yield, and the dividend payout, right? So we talked about the dividend payout ratio a little while earlier, and the dividend yield over here is using market prices, right? So we're using the market price per share, looking at dividends relative to the market price per share, whereas the other one is using dividends relative to net profit, right? So it's two different ways to measure the dividends of the company. And they may not necessarily always be the same, because or they may move around differently as well, because when we're using market prices, then market prices can tend to be quite volatile and move around a lot. Market prices tend to be a lot more volatile as compared to earnings, right, or as compared to net profit. So we would generally expect that the dividend yield is a more volatile indicator as compared to the dividend payout. But nonetheless, this is a very good statistic, because as an investor, it tells you exactly how much you're paying and what the dividend return you're going to get based on what you're paying for the share. So from that perspective, the dividend yield is in fact an extremely useful ratio. Valuation ratios, price to free cash flow. So the final ratio we'll look at for this lecture, and the final valuation ratio, is the price to free cash flow. The price to free cash flow measures the market price per share relative to the free cash flow per share. So in this case, we're looking at how much are we paying, right, for a given amount of free cash flow, right? So just like we did with earnings, right, how much do we pay for a given level of earnings, we're looking at how much do we pay for a given level of free cash flow. So to calculate this this ratio, we take the market price per share and divide it by the free cash flow per share. So as we said, this ratio tells us how much we are paying for a given amount of free cash flow. And one of the reasons we use the price to free cash flow ratio, we use it as an alternative to the PE ratio. And this again comes down to the way earnings can be manipulated. And free cash flow is much more difficult to manipulate as compared with earnings, right? Because free cash flow means you can only look at the actual cash that's come in, minus your capital expenditures. So it's very hard to manipulate like you do with earnings. For example, we've talked about depreciation methods and other things that you can do with earnings, which you cannot necessarily do with free cash flow. So often free cash flow can be a better representation of how the company is doing. If the company has high capital expenditures and that is expected for some time, then the cash flow will be affected by that, and we can then take that into account whenever we are doing our valuation. So that's how we would use the price to free cash flow ratio. Okay, so this now concludes our discussion on valuation ratios. So valuation ratios, the main theme among all of them is that we tend to use them to compare companies within the same industry, right? Because what you'll find is that there's a lot of variation across industries for each of these ratios, right? The PE ratio for one type of industry may be very different to the average PE ratio of another type. So we need to compare within the industry rather than across industries whenever we are using these valuation ratios. Conclusion. So this now brings us to the conclusion of our lecture on financial ratios. Now in this lecture we have spent this time discussing a variety of different types of financial ratios. Okay, and we've kind of gone through them in a fair amount of detail. Now this is a point that we mentioned earlier, but I just want to reiterate it. first of all, some ratios are more relevant for certain companies and industries. So, for example, when we're talking about, let's say, ratios that look at, how much fixed assets the company is using, right? So the fixed asset turnover, for example, then that's particularly relevant for companies that have a lot of fixed assets. So primarily manufacturing companies. So we need to keep this in mind when we look at these ratios, right? We cannot really look at a fixed asset ratio for a company that's in the service sector that only has offices, right? So that would not be very, very informative. So we need to adapt our in the importance of each of these ratios depending on the company or industry that we are looking at. And also, as we said, ratios do vary a lot between industries. And this is primarily for the reason discussed above, is that the different structure of companies, means that these ratios change a lot, right? So even if you think of something like, payables days and receivables days, in some industries it might be very common to have a long period before payment is made. In other industries, maybe payment is made right away. So this can create a lot of difference between different industries. So the best way to use these ratios is to compare companies within the same industry. So that's very, very important to remember. And if we compare companies within the industry, then we can actually see, well, maybe this company's PE ratio is too high, maybe it's overvalued relative to the other companies in this industry. Okay, so that concludes this lecture. This is part 1 of a 2-part lecture on financial ratios. And in the next lecture, we're going to talk more about financial ratios, and in particular, we'll look at an example. So we'll look at Maruti Suzuki, which we did previously as well, and we'll kind of look at some of its financial ratios. We'll have an Excel sheet as well, which you can download for that lecture. So we'll actually get to use some actual accounting numbers and data. So it should be a lot of fun. And finally, we will also give you an overview of DuPont analysis. And DuPont analysis is a very useful financial performance measure. So we'll explain to you what that is, and we'll also do some examples alongside. So thank you very much, and see you next time.